Okay, so we are doing exercise 3.9 on page 347 of the text. I'm going to walk you through the process of doing this and put the answers for you in the Excel sheet here so you can kind of see how these are done. So if we look at exercise 3.9, it says, transaction data for McCall Real Estate Agency are presented in exercise 3.8. And the instructions say journalize the transactions, do not provide explanations. We will not provide explanations in any of our journal entries ever, okay? Real world you do, this class you don't. Okay, so we're gonna look at exercise 3.8 to get the information we need. And it says this information relates to McCall Real Estate Agency. And it's got a bunch of information for the month of October. So we've got October 1, 2, 3, 6, 10, 27, and 30. So what we're going to be doing is we're going to be looking at each one of the statements, which would normally come from source documents, right? But this is how we're getting our information. And we're going to analyze and journalize each transaction, okay? So October 1. Well, first of all, who are we? We are McCall Real Estate Agency. So we're McCall Real Estate Agency. We're the company, okay? October 1. Stockholders invest $30,000 in exchange for common stock of the corporation. So we ask ourselves, well, what did I get? Well, I got $30,000. Anytime anyone invests money in my company, I'm getting cash, right? Cash. So cash is what kind of an account? It is an asset. Assets have a debit balance. So how do we make that go up? We are going to debit it. So we're going to debit cash because we always do debits before credits, right? So we're going to debit cash. So the date is October 1. The account is cash, and we're debiting cash $30,000. Okay. So what else did we get? Well, what else we got is $30,000 in common stock. So we have $30,000 worth of common stock holders, right? Common stock has a credit balance. So in order to make that go up, we are going to credit it. So we're going to credit common stock $30,000. Now, do you think you'll see that entry again? Yes, you will. You will have an entry that has something to do with issuing common stock in your homework and on your exam. Okay. October 2nd. October 2nd. Hires an administrative assistant and an annual salary of $36,000. Okay, what did we get? Well, we got an administrative assistant. Was that an economic event? No. It is not an economic event because we didn't pay anything, right? We didn't promise to pay. The person didn't work and we owe them money. We just hired them. What if they never showed up? They might never show up, right? So what we put, now in the real world, you would not put no entry because in the real world, if you put no entry, you would have pages and pages of no entry every day because that's the way so many things come across your desk. So we're just doing it in this class, and I think mostly just this chapter. You would put no entry, 0, and then you would put no entry, 0. So you would debit a 0 and credit a 0 at no entry. That's the way you need to do it in Wiley to get credit for it and for it to be correct. Okay? All right. Now we go to October 3rd. October 3rd, buys office equipment for $3,800 on account. So what did we get? Well, we got equipment. And what kind of an account is equipment? Equipment is an asset. Assets have what kind of a balance? They have a debit balance. So to make it go up, we need to debit it. So we're going to put October 3rd. We're going to debit equipment. How much are we debiting equipment? They said $3,800, right? Okay. What else did we get? Well, it says on account. So this is an accounting term that you'll need to know. Whenever it says on account and you're the buyer, that means you bought it on an accounts payable unless it says notes payable. And if you're the seller, then it's going to be accounts receivable. But in this case, we're the buyer, right? We're buying the equipment. So we bought it on account, which means we have a liability, accounts payable, liability. Liabilities have a credit balance. So to make it go up, we are going to credit it. So the account is accounts payable, and we're going to credit it $3,800. Now we're going to go to the next one. October 6th. Sells a house and lot for EC Roads, commission due from Roads, $10,800, not paid by Roads at this time. So who are we? We're a real estate company. And how do we make our money? Well, we make our money by selling property or renting property, right? So in this case, we sold a house and the commission due from Roads is $10,800 not paid at this time. So what did we get? Well, we got revenue. We got revenue. We didn't get cash, right? They didn't pay us yet. So we got revenue. So what kind of a balance does revenue have? Well, revenue has a credit balance. So to make it go up, we have to credit it. But the rules say that we debit before we credit, right? So what are we debiting? Well, if we didn't get cash, it says not paid by Roads at this time. So that means they're going to pay us later. That means we are going to receive the money later. That's going to be an accounts receivable. We're going to receive the money later. Accounts receivable is an asset. Assets have a debit balance. So in order to make it go up, we are going to debit it. So that is the first part of our entry. The debit is always the first part of the entry, right? So October 6th, accounts receivable, and it's $10,800. So we're going to receive that from Roads later, and we're going to credit service revenue, because the only revenue that we have in this part of the book is service revenue. So anything that's revenue is going to be service revenue. Okay, so we are crediting service revenue $10,800 to make that go up, right? Now we go to October 10th. Receives cash of $140 as commission for acting as rental agent renting an apartment. So what did we get? We got cash. What is cash? Cash is an asset. Assets have what kind of a balance? They have a debit balance. So to make it go up, we are going to debit it. So October 10th, we're going to debit cash. We are debiting cash $140. And what else did we get? Well, it's a revenue, because that's how we make our money, right? That's how we make our money in the business as a real estate agency. So it is service revenue, and service revenue has a credit balance. And in order to make it go up, we are going to credit it. So we're crediting service revenue $140. All right, two more dates. 27th, pays $700 on account for the office furniture purchased on October 3rd. So whenever it says pays or paid, the cash account is involved on some level, okay? So if we're paying, our cash is going down, and we're paying. So our cash is going down. Cash is an asset. Assets have a debit balance. So to make it go down, we have to credit it, right? But we can't do the credit first. We have to do the debit part first. So what is the debit part? Well, whenever a problem refers to another date within the problem, you go back and you look at that date. So here it's telling you that it's the office furniture purchased on October 3rd. So if you go back and you look at the office furniture purchased on October 3rd, right? You purchased it on an accounts payable, which is a liability. And a liability has a credit balance, right? Well, if we're paying on that bill, that means that our liability is going down. And if liabilities have a credit balance, in order to make it go down, we're going to debit it. So we are going to be debiting the accounts payable account so that it goes down. So we owe less money because we're making a payment on it. So the date is October 27th. We are debiting accounts payable, make it go down because it's a credit balance account, $700. And then pays or paid, anytime it's pays or paid, we know it's cash and we're paying. So cash is going down. Cash is a debit balance, so we credit it to make it go down. All right, last one, October 30th. Pays the administrative assistants $3,000 in salary for October. So anytime it says pays or paid, cash is going down if we're paying. And we're paying, so we know we're going to be crediting cash. So that's the second part. So it says pays the administrative assistants $3,000 in salary. So that's going to be an expense. And it's salaries and wage expense. And expenses have a debit balance. So to make it go up, we are going to debit it. So we're going to debit salaries and wages expense, 3,000. And then we are going to credit cash because it said we paid it. Pays or paid is cash. All right, so that is exercise 3.9 on page 347.